today, after really a little more than a decade of a strong US dollar environment and a strong US Treasury environment, the world has now turned on its head, and we are now in a structurally weak dollar and a structurally weak US Treasury market. This is a very important shift in our global investment environment. For me, the big question is whether this shift is going to be, in essence, put into warp speed over the coming months and quarters through because of rising oil prices. Now, the story on oil prices is a pretty simple one. I'll start off, I thought I had the chart, but I don't, sorry. I'll start off with the simple observation that 12 years ago, the US was producing 5 million barrels per day of oil. The US then moved to producing 13 million barrels per day 2 years ago. And this production has now fallen back down to 11 million barrels per day. Now, the reason this matters is while US production is going down, US consumption over the coming months is likely to go absolutely through the roof for a very simple reason. As the US reopens, everybody will be desperate to be anywhere but their living room, their kitchen, their town. Everybody will want to get on the road and go check out somewhere else. Now, in a normal summer, the US consumes roughly 9% of global oil every day. The US consumes 9.75 million barrels per day. Last summer, of course, that was roughly 8.5 million. This summer, by all measures, I think we'll be breaking through 10.5 million barrels per day. The big question, of course, is where will that extra oil come from at a time when inventories are basically back at 4-year lows? The answer is that the US will have to import its oil. The US will have to import more oil, and they'll have to do so at a higher price. And as it does, the US trade deficit will continue to reach new lows, and petrostates, whether the Middle East, Russia, Nigeria, Venezuela, etc., will be getting richer. Now, the big problem, of course, is that as these countries get richer, what will they do with their dollars? As Russia earns more dollars, as Venezuela earns more dollars, as Saudi Arabia, Libya, the UAE, Qatar, as all these guys earn more dollars, will they take these dollars and recycle them back into the US, mostly by buying US treasuries? Or will they buy something else? Last time around in 2000, they bought something else. Last time around, when you saw a big deterioration in the US trade balance linked to energy between 2000 and 2008, all the petrostates took their dollars and replaced them for euros. They bought euros because at that time, the euro was the new kid on the block. It was the new exciting asset. And so if you were the sovereign wealth fund of Saudi Arabia or the Libyan Investment Authority, you went out and you bought euro bonds. Are they going to buy euro bonds this time around? It seems highly unlikely. It seems highly unlikely because now all of a sudden there's question marks over the euro project that you didn't have 20 years ago. And of course, because yields in Europe are now so ridiculously small. So the next question I'll ask you is, will the US have a strong driving season? And if, like me, you believe yes, then that means that oil prices are likely to move, to break out on the upside. And this especially if the US driving season occurs at a time where simultaneously Europe is reopening, which seems increasingly likely. In such an environment, you can expect energy stocks to outperform, yield curves to steepen further, and the US dollar to go down further.